You have heard it time and time again. Investing is the key to financial freedom. There's no denying that this is true because you have better chances of becoming financially stable through investments than solely relying on your savings and income. But if there's no denying that idea, why are there still a lot of people losing a lot of money in their investments? Where did they go wrong? Today, we are going to look at the common mistakes people do when investing. You will be surprised at how easy it is to make these mistakes, but you can avoid putting yourself in such situations if you prepare in advance. Before anything else, I would like you to click the subscribe button and turn on notifications. This is the only way that you can support our channel and be the first to view our new videos. With that out of the way, let's discuss 5 actions that no investor should do if they want to succeed. Number 1. Borrowing money to start a business. Although there is no doubt that a business can be a good investment option, provided that you manage it well, a lot of people commit their first mistake with it by borrowing money. Those who are not that experienced with running a business think that having huge capital will solve their problem. That is clearly the wrong assumption in several ways. First, it gives you the impression that you have to borrow money to have everything right from the get-go. A lot of business owners spend more years than they ought to enjoy a return on investment as they spent a lot of time clearing their first debt. And that leads to the second problem. There is no assurance that you will get a return on your investment within a set amount of time. Remember that businesses are always at the mercy of the market. If things don't go exactly as planned, you might end up losing more money than you initially put up for that business. The clear solution here is to spend time building your capital yourself. It won't matter how long it takes, but just make sure that every penny you put into that business is 100% yours. If the solution you have for your problem on capital will lead to another problem that requires time and money to fix, then perhaps that is not the best way to start your business. Number 2. Mixing investing with trading. If you look at the stock exchange, you might get the impression that investing is buying and selling stocks from different companies and industries minute by minute. It's easy to get that impression about investing in this fast-paced and cutthroat activity because that's what you will see in the headlines. You might be surprised, but what you are seeing is not actually investing, but trading. What makes a trader different from an investor is how long they hold on to their stocks and what they take advantage of in the market. A trader will buy stocks and sell them as soon as prices go up, taking advantage of the typical minute-to-minute volatility of the market. For example, a trader can buy stocks at $100 and then sell within an hour if the prices go up to $110. That change might be small, but the trader guarantees a $10 increase in his capital before that day ends. A trader could invest in a risky company and still earn before the market closes. That might be a good strategy to earn money, but it is a totally different game from investing. As an investor, you have to be more careful with your investments. You have to look for a company with a high potential for growth and longevity. After all, you will become a part owner of that company, which means you are entitled to a share of the annual profits. Thus, you have to pick a company that shows quite a lot of promise or has a history of strong performance in the market. As the company grows, so too will the value of your investment. Of course, you have to be patient in investing, as it takes years for returns to start pouring in. But if you pick your stocks right, you might just enjoy a healthy return on investment before you retire. Number 3. Being emotional. Another massive mistake people make is making their investment decisions too rashly. This can either happen by selling their stocks at the slightest price drop or investing in them once their prices start to go up. Being too reactive as an investor can be problematic in the long term. There's no telling what direction that company is heading in the next few years. Perhaps that small price change does not indicate a new downward or upward trend. You might end up owning stocks with continually decreasing values or letting go of those that have yet to reach their peak. This is what happened when everyone started investing in Bitcoin in the late 2010s. Without even trying to understand how cryptocurrencies and blockchains work, these people just invested in Bitcoin since it was the hottest thing in the market. They were not prepared for the infamous volatility of crypto at that time. Some even fell prey to crypto scams. To avoid this, take the time to think things through, especially if there are noticeable price changes in the market. Do some research and read through market forecasts. They might not accurately predict how things are going to develop in the market, but making an informed and logical decision is 100 times better than an emotional one. Number 4. Getting trapped in a sunk cost fallacy. This might sound too technical, so let us explain it all in simpler terms. Let's say that you bought a ticket for a movie that you don't like but sit through it because you already paid for the ticket. Another example is if you maintain a toxic relationship because you have invested too much emotionally and financially in building that relationship in the first place. The sunk cost fallacy works in the same principle. You hold on to things that you invested in because you have already paid a decent amount of money for them. For example, you might have bought a car that you rarely use but still keep it because you have paid for it. Or you might hold on to stocks in a floundering company because you have already paid for those stocks. What makes the sunk cost fallacy problematic is that it prevents you from cutting your losses and moving on to better opportunities. Whatever you have invested in, always remember that the money you have paid for them won't always be coming back. If it starts to make you lose money just by owning them, you might as well let them go. With luck, you might sell these investments and gain back some of the money you paid for them. Either way, pick an outcome that is best for the future and not the one that merely justifies the past. Number 5. Not venturing out. Perhaps the biggest mistake that many people make is thinking that wealth is limited. In other words, those at the top are rich because they are keeping all the money to themselves and leaving the rest of the working class to live off the scraps. Although there is some truth to wealth inequality, that should not be an excuse for you not to try finding out more sources of income. You have to keep in mind that many of the richest people today got to where they are because they innovated. In other words, they ventured into sectors that nobody had gone on, and offered solutions that nobody else had thought of. So regardless of your chosen investment, try to venture out of the saturated market. Take the time to research what niches have not been properly tapped on before, or a new angle for which an existing pitch can be delivered. If you are that bold, you might even take advantage of current social problems and introduce products and services that address them. You might not be the best in that growing market, but being the first helps you set the standard upon which everybody else will be judged. And of course, the first to venture tends to command the biggest share of the market until the rest of the competition catches on. So that does it for this video. I hope you have learned something and can find ways to make the most out of your investments. Before we end this video, do not forget to like, comment, and subscribe. And until the next video, take care.